when you want to sort through and see if a deal's worth underwriting further, let's go analyze a quick deal and upload some documents. So you got the rent roll, you got the T12, you got that from your broker. You're going to pop those docs right in here and pop in the address. It's 265 units. We're asking $45.5 million. Is this deal worth it? So we're going to run through, look at the economics provided by the brokerage for this specific deal. You can either do this manually or you can go through and just upload the rent roll into T12, and we'll show you exactly what that looks like on our end. All right. It's reviewed the files. Let's review them in the workspace. All right, we got the rent roll. We can go through the rent roll here. We can see what the turnover looks like, if anyone's delinquent, market rent. We'll go through, we'll import that rent roll. And then as we're moving through the process here, that's been approved. We're going to review that T12. Just going to give a quick scroll through here. Loss to lease, we can exclude that. This is all the income line items and all the expense line items. So the rent roll populated our rental income, and then we have all of the other line items that we'd want to evaluate really quickly. And boom, imported. So we have some default assumptions that we can set ourselves, and as we go through, we can see obviously this deal with our assumptions already just is not working. So what we would need to do is just check, we've already hit the rental income, we've imported that, the other income, all 27 items imported, vacancy, delinquency, concessions already imported, general expenses. I mean, we can see this thing's not worth $45.5 million. It's going to lose money. And that's by using just some loan defaults that we have already here. So I've set my assumptions, how I like to underwrite deals. You can see as we go through the lender sizing, this isn't even close. It's just not going to wind up working out for this deal. We actually have this that pops up, kind of tells lets you know a little bit about what's working and what's not working with this assumption, right? So we can see right now this assumption is going off of probably the 5-year with the spread. So when we jump back into here, we'll see, yeah, we're going off the 5-year. Can lower the spread down a little bit, see if it improves the loan. Maybe add some interest only. May qualify for something like that. We can see, okay, getting a little better. There's some cash flow. But we can just go up to the top and see, look, we're not going to buy anything at a 4.19 cap, right? This is not 2020, 2021. Cap rates don't match that today. So it's probably closer to a $35 million deal. I'm just going to clone the scenario so we have something to compare it to. I'm going to take all of the information that was in the original. We're going to change this to a $35 million deal and see what happens. 35 million. See, now we're getting right back into a rate that makes a little bit more sense if you're going to acquire a property like this. Obviously, that's a big haircut, $10 million haircut, but nothing here has changed. Income, operating expenses. We're going to pop into the loan again, go back through that, make sure it's copied exactly how we said it is. We are reaching our DSCR. We're getting the debt yield needed to make this deal even more possible. We are going to have to add in some closing costs. I'll just use 3% there as an example. And go through some reserves and CapEx. So if there is CapEx on the property, we can add, some CapEx there. Capital reserves. So, you'll have replacement reserves. Lenders require these $250 a unit on all the units. You're going to go through the capital reserve, and then, hey, you need a closing reserve. You may need, tax and insurance escrow. That could be $500,000 plus on a deal like this. And you may need some working capital for things on the property. So you might want to add something like, an additional closing reserve at $250,000. All right? When you're raising $17 million, $250,000 isn't going to change a deal that much. Forced appreciation. So if we're going to do, say we're going to implement pet rent, right? Maybe 100 of the units. Yeah, I can't put 1,000. Maybe 100 of the units have a pet. We're going to charge $50. It's going to start in 6 months when we implement this plan. That's going to be a one-time value add that we do to this deal. This isn't, any other appreciation. That's just like, hey, one time we're going to implement this, and it's going to stick with the business plan. As we go through here, we can see your income and expense inflation. We can put some inflation on the other income loss. So saying our other income is actually going to go down. We can do a ramp up period. So if we enable this specific setting, we'll have a ramp up period where we can actually say, hey, look, starting in month 1 to month 12, our starting occupancy is going to be 92. We're going to get up to 95, and we want to do it on a linear basis. So let's just do that. I can show you it really quick. These sorts of things allow us to really model the deal up to give you very, very, very much detail in this. So as we see, the price is about $35 million. We're going to go through that. It's going to ramp up. We're going to refinance this deal year 5. Maybe we get a little bit higher LTV. Probably not. We're still going to be in likely a 65% market. And as we go through going through these refis, you can actually pop open what that summary looks like. Looks like at this point we would return, a small amount of capital to the investors. Maybe the cap rates improved a little bit at that time. Maybe the interest rates improved at that time. So we can kind of go through this scenario and model a couple things out. So you can continue to work on this and see where you would need to be. I would recommend doing some crazy refi strategy. As we know, interest rates have changed, cap rates have expanded, so not a time to be implementing that. We may say that, look, we're going to exit this deal at a 5.75 interest rate or a 5.75 cap rate. We have some closing costs in there, and we model that out. Really easy to see, really easy to follow, really easy to understand. You pop the actual projections open, and you get a lot more detail. So as you go through here, you can see, exactly what that detail looks like. You can hit the eye to expand out and see, a little bit more about what is actually going into these numbers. As you continue to work your way down through projections, you get to see exactly, when is a good time to refinance, when is a good time to exit, and what that looks like modeled out. And we also have the sensitivity analysis that you can hop into and go back and forth and see exactly, where we're looking, right? What could happen, what could not happen, what's unlikely, what's likely. You can use the sensitivity analysis to show investors exactly what they're looking for in a deal. And if you're syndicating this, you can set up an easy syndication here. Say you're doing a 80-20 split. You as the managing partners may have a 2% acquisition, 2% asset management. We can select what that comes off of, whether that's the equity, the gross potential, effective gross. There's no CapEx on here. I'm not going to add that. If you have multiple partners, say, maybe you're going in this 50-50 with another co-GP. You're each investing $500,000. Oop, that guy did a little bit more there. You're each investing $500,000. You can see what the equity looks like, what that breakdown is. You may have a pref equity piece on something like this. Maybe you're paying this pref group 9%, just equity only. They're probably going to be like 10, 12%. Just on that equity specifically, that's what you're paying them. And then the rest is a regular syndication, no pref. You can add that here, save it to the deal, and now you can actually see what your syndication breakdown looks like, what those returns look like investor-wise, what it looks like for you as the managers, and you can get a lot deeper when the actual projections, and you can go through all of the advanced analytics as you continue to work your way through. And all of this has taken, I don't know, maybe 4 or 5 minutes here. There hasn't been a lot of extra time I've spent on this. You get a nice clean report showing you exactly, what you're anticipating specifically on this deal. So we can go back through. Not a great cash on cash, pretty low IRR, okay equity multiple. And as you continue to go through these snapshots, you'll be able to look at all of the data that's provided for you, on this underwriting in the matter of minutes, right? We also have a DealWorthIt score on the bottom. The DealWorthIt score kind of lets you know exactly, if this deal is worth it. A 58 out of 100. We all went to school here. We know that 58 out of 100 isn't a great score. We do have some property data available on stuff like this as well. Sometimes the address specifically, like this deal, for example, it has this address on their site, but it may be coming up as a different APM number. But what we do have always available is the market insight. So you'll be able to see exactly what's going on in this market. So it looks like the population growth is there, the employment growth is there, and the rent growth very low. So don't project something overly high. We give you a little risk profile there. And then as you go through some of the underwriting guidance, so you can say, hey, look, currently our projected IRR is 5.6. If we adjust it to these market alignments, right, it's going to be a negative 5.66. So look how small of an adjustment that is, right? For a 1% rent growth, I think we were using 2. We can tell you right here. We had rent growth modeled in at 2. We need to do it at 1. Vacancy we had accurate here, but the expense growth we had modeled at 2%. It's looking like it's about 3.5% in these types of market. So if we apply these market assumptions right now, it's gonna severely affect this deal, and that's just a small 1%. See, people model things all the time and say, 2% rent growth, 2% expense growth. That's not always the most accurate thing. And we can see how much that changes the deal. Just 1% changes the deal 11 points on the IRR. It goes from a positive deal to a negative deal on just 1%. It's a huge impact that these metrics have on the deal. So as we continue to go through, we can see, hey, what's the subject rent? What's the HUD benchmark? What's the median gross rent? And we can kind of work off of those benchmarks and see what's going on in there. We can also go into what the score breakdown looks like for the specific market, where that data is coming from, the coverage of the area, what these market trends are in the area, how's the economy doing, what's the employment look like in this economy. Looks like they're losing some healthcare jobs, not as much growth as there was, but there's some more finance coming in, and then some of the demographics in the area. So all of this data is available for you. You can see the documents that we've uploaded so far to this deal as the rent wrote in the T12, and then any sort of notes that you have on the deal. So super quick, super easy. That took me a couple minutes. I was able to almost fully underwrite a deal. Obviously, we would go a little bit deeper with some of those projections as we moved through something like this, but you can just know right away that, like, look, at $45 million, this deal shouldn't even be looked at, right? Like, not even close to a deal that's going to work. At $35 million, we're getting closer to a number that would, potentially be acceptable, but in all actuality, this isn't a deal. So it was pretty quick, pretty simple. We were able to go through this entire process and underwrite a deal from A to Z in just a couple minutes.